Up next, we have with us Barry Burns, Dr. Barry Burns. Barry Burns is the founder of TopDogTrading.com. He's a businessman with a business background, which told him to focus on the bottom line. So his study on the financial markets was for one purpose only, to make profits. He's been trading since the age of 8, I believe. I believe that's correct, which he started with his father, Patrick Burns.
So what I like about charts is nothing
Barry,
gets
are
plotted
you ready?
in a chart. People take action. Their behavior.
People tell you all kinds of stuff. Oh,
that I'm interested.
we should
in.
buy
What they
here, or
really
this looks
do
bullish, or
goes
that
back
looks
to the old
bearish.
adage
Well,
of
did you
actions
buy?
speak
Are you
louder
in? Have you
than
committed
words.
your money?
Well,
So
no.
I'm mapping
Okay,
their
then that
actual
means
actions.
for whatever reason, what they're doing
the
markets
things,
is people's actions. They're
I'm more
buying,
interested
they're
in
selling,
what they're
putting
doing
the
than their
money
reasons, 'cause
into
usually
the
the
market.
reasons are just
So that's what's
excuse me,
beautiful.
just
What I
about
like about
charts
charts is
we
nothing
blow
gets plotted
through
in a chart until people take action.
because people tell you all kinds of stuff. Oh, we should buy here, or this looks bullish, or that looks bearish. Well, did you buy? Are you in? Have you committed your money? Well, no. Okay, then that's meaningless to me. What moves the markets is people's actions. They're buying, they're selling, they're putting the money into the market. So that's what's beautiful about charts is we blow through all of what they're supposed to do, all of what they say, all of what the pundits are theorizing. And charts don't just map people's thoughts, beliefs, hopes, or fears. They map their commitments. And it's the commitments, putting the money into the market, is what really moves the market. So if the nature of the market is the nature of people, what's the nature of people? All right, it's very interesting that the nature of people is actually reflected in the charts. So human beings are by nature goal-oriented. And, you know, we were born and we have this instinct, this very strong survival instinct that causes us to want to learn how to move, to get mobile. Because if we don't get mobile, we can get eaten up by saber-toothed tigers. So, well, I'm going back a few years here. But that instinct is still there. To get mobile is actually a survival instinct. So that's a very important first goal. Learning how to feed yourself, very important goal. And then as we get older, we have goals of learning, which is also a survival instinct, meeting someone from the opposite sex, getting married, having babies, getting a job, providing for ourselves, moving up, building security. You know, we have our lives are kind of set in a basic linear meta pattern. And in trading, we refer to these as trends. Now, those trends, as we move through life as human beings, we don't go straight from, you know, one goal to another. In real life, it's messier. So as we move toward our goals, we have setbacks. And so we even have a phrase for this. You know, well, I'm going 3 steps forward and 2 steps back. That's how life really works as we move toward our goals. Same thing with the markets. Same thing with the markets. Markets don't go straight up or straight down. They oscillate up and they oscillate down. We have wiggles. Sometimes people in life, they just get stuck in the pursuit of their goals, where they just completely get stymied. And in trading, we call this consolidation, where the market stops trending for a while. Human beings need cycles. We work and then we rest. We work during the day, we sleep at night. Well, most people anyway, depending on your shift. We work during the week, we take weekends off and rest. And the market too has many different types of cycles. But cycles are not evenly patterned time with regard to time. And this is where the study of cycles gets to be very challenging. If it was, you know, a case where, well, the market goes up for 5 days and then comes down for 3 days, goes up for 5 days, goes down for 3 days, trading would be real easy, too easy. Market has no interest in making trading easy for you at all. In fact, the market's interest is to make trading hard for you. Why? Well, again, think of what the market is. The market is the people. It's not some esoteric, mysterious thing. It's people, as we said. So everybody's trying to make money for themselves, meaning that they don't want you to make money because you're their competition. So yes, it's against you, meaning all the other traders are against you. They're trying to take the money out of your pocket and put it in theirs. So, but human beings also, we have these bigger cycles, which are more irregular. And so sometimes as human beings, we get bored with just having a regular schedule. And so, like when I was in graduate school, working on my doctorate, even on my master's before that, I would get ready to write my thesis or a major essay or finals or midterms. I would pull all-nighters. And then, I would crash after that and I'd sleep for a week. So these are called, in the market, we have expanding and contracting cycles. Some cycles last longer and some last for a shorter period of time. So they're not easily measured. And human beings also, what's the other thing with nature of people? Well, another thing is that we're emotional. We love, we hate, we overreact, or we become passive aggressive. And we are certainly not always logical. And this is the nature behind bubbles, market bubbles, where, as Greenspan said, we get into these periods of irrational enthusiasm. It's irrational. The whole thing with the tulip market and the tulip bubble. Even over tulips, people will go through these same things. So with more recently with the technology boom, the real estate boom, these were bubbles. People lose their minds, they lose perspective over the value of things, they overreact. And I still remember at the very top of this most recent real estate bubble, all my friends, relatives, brothers-in-laws saying, oh, you got to get into this thing, it's crazy, it's a whole new paradigm. They said the same thing with the technology bubble. Oh, this is a new paradigm. Things are different now. Fortunately, I've been trading for a long time, so I told them that they were freaking nuts. And those who don't know history are doomed to repeat it. And so I waited, and some of my very close friends, they were buying right up at the top, and I'm like, oh. And I had to advise them. I'd say, well, I can't tell you what to do, but here's historical precedent. You might want to consider this. And sure enough, they bought right at the top, and then they were foreclosed on just a few years later. And of course, they had to buy multiple properties because they were going to be multimillionaires, supposedly. And then some of them went bankrupt. Well, guess what? I bought into the real estate market. I waited while everybody else was going crazy and enthusiastic, and I waited for the market to come crashing down. Then when it did, then I bought. Then everyone thought I was crazy because they said, oh, real estate's no good anymore. Why are you buying now? Well, that's the way to make money. So we've talked about mass psychology. Now let's bring it down to you. Bring it down to me. As individuals, we're trading as individuals, most of us. We're not trading other people's money or for a company. Maybe some of you are. But for most of us, we're trading our own money. And so we are dealing with, yes, the issue of mass psychology as we analyze the markets, but then we deal with individual psychology as we manage ourselves. And in the market, as with pretty much everything in life, the little principle called Pareto's principle applies. You might have heard of it as the 80-20 rule. And I've heard some people say, well, it's even worse in trading. About 5% of the people make 95% of the money. I don't know what the actual percentages are. I don't know if anyone does. But the bottom line is the vast minority of people make the vast majority of the money. So, and the SEC has documented it and puts it on their website that most people, the vast majority of people, I would even add, lose money trading. So that's the fact that we all have to face when we decide to trade. All right, that's an ominous fact as we make our decision. So how do we respond to that fact? Well, every one of us who participates in trading, who decides to go ahead, we think we're different than the masses. And otherwise we wouldn't participate, right? If you thought you were part of the masses and you were going to get their results, well, you know you would lose your money, so then you wouldn't trade. So everyone who's trading, all of us, we think we're different than the masses. The bad news is everyone who trades thinks the same thing. They think they're different than the masses. Guess what? That means, therefore, that you don't think different than the masses. After all, you're thinking exactly like them. because just like them, you think you're going to be the exception. Everyone thinks they're going to be the exception. Therefore, you're not the exception if you think you are going to be the exception. I know that's a little mind twister. I get it. But here's the issue. You can use this to your advantage. The Chinese, in Chinese philosophy, they call this an iron circle, where as long as you stay within this framework or this paradigm of thinking, you cannot get out of it. You are stuck. And that is true with trading for sure. Now, how do you get out of that then? The Chinese say you must transcend the iron circle. So I thought about that. I've studied a lot of Chinese philosophy and all kinds of philosophy all over the world. And as I thought about this, I thought, okay, how do I transcend this? How do I get out of this? And so I came up with a little technique. It's kind of a basic biofeedback technique. It's not using the actual, machinery and so forth of biofeedback. But here's how I did it. Here's a practical exercise I'm going to give you, and you might want to try this. It's up to you. It's work, okay? I'm going to tell you right now, of course, trading is a profession and it takes work. It's not a get-rich-quick scheme, so those who want to really succeed are going to have to put in a lot of time. Here, this is something that helped me tremendously, and you can do this and you can do it for free. Here's what I did. I attended a lot of the free live trading chat rooms where traders are actively communicating with each other. Now, the key to this is that you don't want to get into the chat rooms for this purpose. You don't want to get into the chat rooms where there's professional traders who are helping you. Okay. Now, those can be great, for another purpose. For example, from learning from that master trader, then that's great. But for this exercise, you don't want that type of chat room. You want the ones where there's, usually they're free because there is no professional trader there, and frankly it's a bunch of losers all talking back and forth about what's going on in the market live during market hours. And by the way, when I say losers, I don't mean that in a derogatory sense. I just mean it in a literal sense, people who are losing money on a regular basis. And what I would do is I would listen to all their comments and I would watch the charts they were trading in conjunction with their comments. All right? Now, remember, the masses are wrong most of the time. So what you're hearing in those chat rooms is the inner dialogue and the behavior of the losers. What they're typing in or what they're saying is their inner dialogue. And then what they're doing, and you watch that on the chart, is their behavior. Now, do this for 3 to 6 months. It takes a little time. It takes repetition is the key. And over that 3 to 6 months, every day, you're listening to their comments, and in conjunction with that, you're watching their charts. And before long, you'll be able to do the reverse. Because what you'll see is there's many, many patterns, very typical patterns that come up between what people say and what happens. And you'll see, for example, I'll just give you one concrete example to kind of put this in perspective. So one of the patterns that I noticed was, let's say that the market was trending up. And people would type in things like, oh my gosh, this is trended so far, it can't go any farther. So I'm shorting here. And they would short. And sure, the market would come down just enough to fill their order and then turn around, go back up and stop them out. And then they would type in a few expletives and, I won't repeat what they would say, but they were upset, obviously. And the market would go up even higher. And then they would say, oh my gosh, we're in, be various things. Oh, we just broke this, we're right up against this, major Fibonacci cluster, or we're beyond the average true range, way outside of that. This is historically unprecedented, whatever. And they would just say, we're way beyond the beyond. Or this is an exhaustion pattern was another one they would say. Bottom line is they just kept thinking the trend was over. It was way too extended. So they would short again. Market would come down just enough to fill them, turn right back up, and stop them out again. And that would happen like 2, 3, 4, 5 times in a row until finally they get disgusted and say, oh my God, that's it. this market is crazy, it makes no sense, nobody can trade this today, I'm going and playing golf, and they'd leave the room. Well, I must have seen that same pattern happen 100 times if I saw it once. So what would happen is, well, then I could do the reverse. Because of the tremendous repetition of certain patterns like that, that's just one. Pretty soon, after 6 months of this, I could do the opposite. I could just look at the chart, and I could tell you what the losers were saying, what their inner dialogue was. Because I would see a pattern, and I would say, oh, here's this pattern. I know exactly what the losers are thinking. And that is a very, very powerful insight to have. And this is how I was able to transcend that iron circle, because I would learn what the masses are thinking and learn to think differently than the masses. Very interesting exercise. Yeah, time consuming, but let me tell you, it'll change your trading forever. In Market Wizards, fantastic book, classic book. Probably most of you already heard it. Probably many of you have read it. If you haven't, please get it, read it. It's amazing. Jack Schwager, what he did was he interviewed some of the world's most successful traders in search for a commonality that led to success for others. So again, what he's doing, interviewing the most successful traders in the world and trying to find out, what do these people all have in common? So is it an indicator? Is it some, trading pattern, price pattern? What? Here's his conclusion that they all had had in common. He says, what set these traders apart? Most people think that winning in the markets has something to do with finding the secret formula. He said, the truth is that any common denominator among the traders I approached had more to do with attitude than approach. So again, it wasn't so much techniques or indicators or price patterns or any of that kind of stuff, but it was more the mental game. He's actually written quite a few of these books now, but his follow-up book, New Market Wizards, he said, we has met the enemy and it is us. The famous quote from Walt Kelly's cartoon strip Pogo would provide as fitting a one-line summation of the art of trading as any. Time and time again, those whom I interviewed for this book and its predecessor stressed the absolutely critical role of psychological elements in trading success. When asked what was important to success, the Market Wizards never talked about indicators or techniques, but rather about such things as discipline, emotional control, patience, and mental attitude toward losing. The message is clear. The key to winning in the markets is internal, not external. I agree with that 100%. So it's obvious that to be a successful trader, you need a viable trading method with setups, rules, and plan that works. In fact, some people say, well, the psychology of trading is more important than the actual, trading method. I disagree with those people. Both are required, first of all. It's both. But it's not a chicken and egg scenario. To me, it's very clear that you first must have a successful trading methodology. Because if you have an unsuccessful trading methodology that just doesn't work mathematically, then it doesn't matter how much discipline you have, the system doesn't work. So if you're disciplined in following a faulty system, well, you're still going to lose money. So first comes the trading methodology. Get a successful one that works. Then you apply discipline to that. The problem is, though, that there's many people who say, gosh, I've tried method after method after method and none of them work. But what they're not realizing is that there's many traders who actually do have a viable trading method, but they don't know it. Why don't they know it? Because they've never tested the method divorced from their emotions. So for this reason, I highly recommend that you paper trade. Actually, we used to use the term paper trading. Now I really recommend people use an electronic simulator or demo account so that you can get used to actually executing those orders, making the commitment, getting the feel for doing that. And do this for at least 3 to 6 months of successful trading. It's very important that I put in that caveat before you put in a single real money trade on the line. And again, that trading must be done in real time, not after the fact. So again, this gives additional benefits for helping you learn the timing of entries when you're using the electronic simulator. All right. Okay, I'm a little behind, so I'm going to skip this slide and move forward because I really want to get to some other things here. Yeah, there's some good book here, by the way, I'd like to recommend to you. John Patrick, Money Management for Gamblers. Money Management for Gamblers. I won't go through this quote because of the time constraints, and there's some other things I want to get to. But that's not a book about trading. It's a book about poker. But what he talks about there in regards to the psychology of being a poker player applies very much to trading. He's a very colorful guy, so it's very humorous reading as well. John Patrick, Money Management for Gamblers. Highly recommend that. Okay, now let's get down to the second exercise that I wanted to share with you. This is really, 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 really powerful. I want to give you guys some practical things to help with the psychology of trading. So that's why I wanted to make sure I gave you one exercise. I'm going to give you another one. So in your trading every day of the week, if you're not trading well, but you do have a successful trading methodology, it's most likely because you're making mistakes. For those of you who enjoy American football, I love football. I was a football player myself. I'm from the beautiful city of Detroit, Michigan, one of the most lovely places you'll ever see. For those of you who don't know about Detroit, I'm being completely sarcastic. They just went bankrupt. Yeah, it's not a nice place. But anyway, because of that, even though I live in California now, I don't know. I'm just a very, very, you know, a sentimental person, and so I continue to root for Detroit teams. Well, the Detroit Lions have been a horrible football team. This year, they're actually doing pretty good. They're at the top of their division. They've got amazing players, incredible, some of the best players in the league. And yet they're struggling to stay at the top of their division. Why? Well, it's because they make a lot of mistakes. They turn the ball over too much, interceptions, fumbles, and they get a lot of penalties. They rate one of the worst teams for penalties. So they're defeating themselves. Even though they have these great players, they're defeating themselves with penalties and turnovers. And that's what a lot of traders do. They defeat themselves. They have a great player in the sense of a great trading method. They don't even know because they're making mistakes. So I've created a little list here. I call it the 10 Commandments of Trading. And again, we don't have time to read through all of these. However, I will send you a copy of this. And these 10 Commandments of Trading basically translate into the 10 most common mistakes people make when they trade. So send me if you want a copy of this, send me an email at Barry, B-A-R-R-Y, at topdogtrading.com, and I will be happy to send this over to you for free, no charge. Just let me know you want the 10 Commandments of Trading or the 10 most common mistakes. You can call it either one, and we'll attach it to an email and send it back to you, okay? And that's a starting place for you. Now, everyone has different mistakes or issues they deal with, but that's a good place to start because that came out of my research of following traders and seeing what the most common mistakes were among traders. One of my favorite sayings in trading is successful trading is simply a matter of not making mistakes. Some people agree with that, some don't. I just read an article of someone who totally disagreed with that, and he made some good points. But again, the point is, once you have a good methodology, this assumes that, of course, then it becomes an issue of not making mistakes. I have found this to be very true in my own life. As long as I don't make mistakes, I come out ahead. I win. The mistakes I refer to are those 10 commandments. Now, here's the question then. How do we, in a practical sense, how do we avoid making these mistakes? Okay, so what I did, and again, I'll be happy to send you guys a copy of this if you'd like. Just send me an email and send you a copy of this for free. I use a trading log. Now, everybody uses trading logs, okay, and that's fine. But most people just put in, you know, when they entered, when they got out, how much money they made. That's useless. Your broker can, you know, give you that every day. So mine's a little different. what I do, the keys to mine are, okay, yes, I enter in all the data here as far as entries and exits and so forth. Then I have two important areas. One is for notes. The notes, what I actually put in here is two things. Number one, what was I thinking when I took the trade? And the second thing I put in, what was I feeling when I first took the trade? See, we're getting back to the beginning of the webinar now. People trade based on their thoughts, feelings, beliefs, and so forth. So I want to analyze that in every single trade. You know, what am I thinking right now? Okay, so it might be, oh, this market's so extended to the upside it can't go any higher. Okay, well, if I wrote that right away, I would say, oh, dang it, I should not have taken this trade, because that's what losers think. That's a loser's inner dialogue. What was I feeling? Maybe I was feeling nervous, or I was feeling really confident, or uncertain, or hesitant, or whatever, or greedy. I'm trying to make back some losses I had, so now I'm getting aggressive. Whatever it is, whatever feeling I put there. Then over here, this is the most important section in this yellow area. Here's where I put my mistakes. I refer back to that list of 10. And by the way, that list is meant for you to customize. Again, that's just a starting point. Then you might have some unique problems you have, mistakes you make that aren't on there. So you add your own. And here I list them. Oh, what mistake did I make on this trade? See, that's one trade right there. Oh, I got out too early. I saw that it was up, you know, $5, and I was so excited that I was making $5 that I closed out my position. Okay, so that's getting out way too early. You know, or it might be that I'm trading too frequently, or I'm revenge trading, or whatever. And so you list that here. And here's your second trade of the day. There's your third trade of the day. Or if you're swing trading, you know, put it here too. Now, here's the key. I'm going to be having a list of all the mistakes that I made and all my thoughts and feelings for every trade. Okay, very important to document that. Oops, what's going on here? There we go. Now, this is my weekly trading log. So at the end of the day, if I'm a day trader, then I take all that information and I summarize it in one row. The date, here's the number of wins I had, the number of losses I had that day. My total profits that day, total dollar amount of losses. My average dollar win, my average dollar loss per trade. Then don't forget to add in your commissions. And then here's my net profit or loss for the day. And then over here is percentage of account. The win or the loss I had that day, how much of my account, based on the percentage of the total amount in my account, did I win or lose? Then here we put in the number of mistakes I made. Then this is really key. My net profit and loss if I didn't make any mistakes. And then here I'll list the specific mistakes. So if I got out of a trade too soon, say 3 times that day, well, I'll just list it once, but then I'll put 3 next to it. Got out of trades too soon 3 times. And I list them here. Now, 2 key things here. Number 1, because you've translated this or transferred this over to a weekly log, here's day 1, 2, 3, 4, and 5. And I'll start to see patterns, which you're not totally aware of unless you write it down. So I'll see how many times I get out of a trade too soon. I might have a general idea before this that I do that, but then when I start seeing it and I say, well, I did it 3 times this day, 5 times that day, 4 times this day, 6 times that day, 3 times that day, holy mackerel, this is a mirror. This piece of paper is actually a mirror holding up to your patterns, your bad trading patterns. And it's right in front of your face, and all of a sudden you realize, I got a problem. It's almost like the first step in AA. You know, you've got to acknowledge you have a problem. But unless you write it down and you see it in writing, you're not fully aware of how big of a problem you have. Also, yeah, we've got the list of 10 mistakes, but not all 10 of those maybe are problems for you. You'll find out which ones are a problem for you and how often they affect your trading. And then you look at this column, and this is the one that is the wake-up call. This is the one that motivates you. See, people say, yeah, but how do I get motivated to change? This column. Because now you say, okay, you take your results, your profit and your loss, and you go back and you take out all the losses you had on trades where you made mistakes. And you subtract all those losses where you made mistakes, and you find out how much money you would have made this day, this day, this day, this day, this, and then at the end of the week. What often happens with students that I've worked with this is they find out, oh my gosh, if I didn't make any mistakes, I'm already a profitable trader. I'd already be making money. And it blows their mind. But it also excites them, because then they say, wow, that's cool. Man, hey, I'm a profitable trader if I just eliminate these mistakes. And that motivates them. Very, very powerful tool. Again, does it take some effort? Does it take some time? Absolutely it does. Of course it does. But trading is a business. It's a profession. And like any other profession, you got to put effort and time and energy into it. And most people are not willing to do this. And there's a famous saying, one of my favorite famous sayings about success is, successful people do what unsuccessful people are unwilling to do. And so that's what is true here. With that chat room exercise, with this exercise, it takes time, takes effort. Most people are not willing to do it. Successful people do what unsuccessful people are unwilling to do. So that's what I have for you today. I wanted to give you, again, some practical exercises that will really help you in your psychology of trading. As I said, I'm not selling you guys anything today, but I do have a free 5-day video correspondence course, and maybe you guys at Real Traders there, can you type in the link for this? I know you have a special link for it through the Real Traders.
Yeah, it's
website.
there, Barry. It's realtraderswebinar.com/topdog.
Well, there you go. That's easy. Great. Thank you. So you go there and you can pick up for free this 5-day video correspondence course. That's my gift to you today. No obligation or anything like that. It's 5 days of videos. You get a new video each day for the next 5 days starting today. And this course is actually called How to Succeed at Trading by Breaking Every Rule You Were Ever Taught. It teaches you very heterodox approaches to trading, why some of the classic orthodox things you've been taught don't work. And then what does work. The flip side of that is, of course, I don't teach you what doesn't work, but what does, or how people are misreading technical analysis and things like that. And then at the end of each one, we have an interactive quiz, so you can actually review the lesson, you're quizzed on it to see if you're right or wrong, get instant answers. And, oh, last thing, on day 4 of the 5-day video course, I give you one of my favorite trade setups. And again, this is one that I used to only sell, but you guys are getting it for free. It's called the rubber band trade. It's so good. Every time it sets up, I always trade it to this day. And you get the rules for that, the filters, everything. Rubber band trade, that's on the 4th video. So that's great. Well, I'm out of time, so I don't have time for Q&A, but if you do have any questions, my email's there at the top, barry@topdogtrading.com. Would love to answer any questions you have. Feel free to send me an email. Don't be shy. I love talking with traders, so I'm happy to do that. And I hope you got something out of this. I enjoyed being here. And again, thanks to the great people here at Real Traders for sponsoring this event and bringing in so many wonderful, wonderful speakers. I'm really enjoying this, and I hope you are too. So thanks, everybody.
Thank you, Barry. Special thanks goes to Barry for always being a great contributor to Real Traders Webinar. You can also check out Barry on our podcast at realtraderswebinar.com/podcast. And make sure you check out Barry's offer, which you could do again at realtraderswebinar.com/topdog.